Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. We are back with another coffee break session. Craig, welcome back to the show.
I'm glad to be here.
Interest rates are a hot topic right now. Today I wanted to talk about floating interest rates. So what are floating interest rates?
So it's a good question. What are floating interest rates? And by contrast, would be what are fixed interest rates? So floating interest rates are rates that you pay for borrowing funds or for some type of outstanding liability. They can move up or down based upon some underlying base rate plus some type of spread. That's how it usually is determined. So a base rate plus or minus a spread.
Okay, and what are the factors that influence changes in these floating interest rates?
Well, there's usually two factors, one for the base rate and one for the spread. The spread would be influenced by the credit quality of the borrower. So if the credit quality changes, let's say a certain level of debt is reached, the interest rate may go up, or if a certain amount of debt is paid down, that rate may decline. The other is the base rate, how the base rate changes. That's oftentimes impacted by the underlying IBOR rate, whatever that IBOR rate is, how that's changed. And that's usually determined by overall economics and most heavily by the central bank's reaction to that as they raise or lower their rate. There's a cascading effect on the particular IBOR.
Okay. Personally, I've heard a lot of negative things about floating or changing interest rates in as far as mortgages go when they had the housing crisis a while ago. How can both borrowers and lenders benefit from floating rates instead of fixed rates?
Well, if, let's say, a consumer, if you're buying a house, and this, you might get a fixed rate or you might get a floating rate, and that depends on the country you're in and what instruments are offered. So oftentimes people feel much more comfortable getting a fixed rate because they know it won't go up during the life of their loan. So they've locked in a particular rate. Now, given the fact that most people move within, I forget how many years, I think it was within 5 years, but certainly within 7, the more frequently you move, the more likely you're to realize a better rate if you do a floating rate, because, it might take, 3 cycles before the rate goes up and you'll be paying off at a lower rate. So it can benefit you, especially if you're not going to be staying in your house as long, to go with the lower rate. But a lot of people don't feel comfortable with that. They want to know, hey, it's my house. I don't want it to go up, 6% over time, if whatever the cap is, if there's a cap. I want to make sure I have a consistent payout. Whether or not that makes financial sense or not, it certainly would be their desire. Now, for a business, there's a potential you have easier access to floating rate funds at the time of borrowing. That may or may not be the case. You may find that you have good pricing power with whatever you're selling, whatever you need from a capital perspective. And so you can raise or lower prices along with how those rates may go is what you need. So it can be a good option for you. You might be able to get a longer term as well if you have floating rates. The lender may continue to add some kind of margin there to accommodate that if they don't have an equal offset, where they're getting the asset from to offset the variability on that particular side. On the lender side, you may not have your assets and liabilities not line up exactly right, and so now you have a liability that becomes worth more if rates go up or declines, and therefore you don't have to do any type of matching or offset there. So there's some reasons for variable rates for the lender as well as for the borrower.
Okay, and on the risk side, you mentioned the not knowing being kind of a risk. What other risks are there with floating interest rates?
Well, if rates keep going up and they get to the point where it's more than you can comfortably pay or you're able to pay, so the liability may grow up, may grow and increase and makes it too expensive to be competitive, or it makes it too expensive so that it creates a strain on the organization.
Is there a risk or the risk on the lender side, like in the housing issue that happened a while ago with all the balloon rates? A lot of people defaulted. Is that weighed in on the risk side?
Yeah, no, that's a good question. That's a good example. And I would even take it not just from the housing side, but from the small business side. So a revolving debt like credit card. Small businesses have credit card debt. They may have types of lines or facilities that are only offered to them on a variable rate basis. And so as we saw the Fed increasing the rates, that has cascaded through the markets. And so what have we seen in the U.S.? We've seen a significant increase in bankruptcies, insolvency issues happening as rates have gone up. So those that had some form of leverage were now paying more, significantly more, an increased amount, significantly more. I mean, as the rates rose, that put a bigger stress and strain on those organizations. So that's a good example. So whether it's housing, whether it's revolving debt that's I think always variable, or whether it's some of the different types of revolving facilities that medium and small businesses have, it makes things more expensive.
What type of loans or financial instruments are these floating rates seeing the most?
These would be credit facilities. There's a number of notes that will be pegged off of a base rate plus some spread. Even some invoicing has that as well in certain countries.
Any final thoughts on this topic?
Yeah, because I mentioned the term base rates. I think we need to talk about base rates a little bit.
Okay. What's a base rate?
Many people would be familiar with what's now an outdated rate, LIBOR, London Interbank Offered Rate. That was subject to some scandal manipulation, and so that rate, had this long sunset period, and a number of new rates came up. In the U.S., we think of SOFR, SOFR, which is the Secured Overnight Financing Rate. That's one rate. Also, if you're in the UK, you might be familiar with SONIA. That's another rate. In Switzerland, Saran. In Japan, they have a toner, not like the toner in your cartridge, but TONAR. In the euro, there's, if it's based off of Euribor, Ester is another one. So you can see a trend here, right? There's a whole new set of rates. And so those tend to be the basis in almost all cases. And there's usually a spread plus or minus, and plus some factor for how credit may vary or the amount that's borrowed that can be adjusted, so you don't have to keep repapering a particular loan agreement.
Okay, so the base rate might change based on the country you're in, but then your floating interest rate would go in addition to that, would be added on or taken away.
Yeah, the spread could vary based upon if your credit quality changes, if the amount you're borrowing exceeds a certain amount, or you pay down a certain amount, because that would be a change in the risk profile. The base rate is the base rate. The spread is based upon your particular factor. And so I know we have had a coffee break session on risk-adjusted return on capital, or RAROC, and it's like, this is another way of, when you're lending money, not every borrower is of the same quality, the same credit quality. And since they have different credit qualities, how you adjust for that is, here's the rate that I'm paying for funds in the market, and now I am experiencing a different level of risk with customers 1 through 10. And so I figure out what that adjustment or what that spread would be based upon their credit capacity, the level of risk that exists, and then factor that in.
Cool. Well, thanks for sharing. To our listeners, remember to tune back every first and third Thursday of the month for another coffee break session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.